Bitcoin had an absolutely incredible 2020, receiving widespread recognition as a macro asset for the very first time, and of course surpassing its 2017 highs at the end of the year. Let's take a look at how it all played out. Discussions about the nature and purpose of Bitcoin began in early January, when Bitcoin appeared to act just like gold and oil following the killing of an Iranian general. In reality, the situation was far more complicated than it seemed on the surface. On January 3rd, a US drone strike killed Iranian Major General Soleimani. As this news broke, oil and gold futures jumped in price as traders rapidly priced in the increased probability of oil supply disruptions in the Middle East. Bitcoin also increased in price, but not until about 3 hours after the news broke. It's far more likely that the sudden increase in price was caused by forced liquidations on futures products, something that happened quite frequently at the time. But then things got more interesting. Responding to the drone strikes, Iran launched missiles at a US military base in Iraq, prompting another increase in the price of gold and oil. Not only did Bitcoin move with them this time, but it did so with far less vertical motion than before, implying the price action wasn't the result of sudden liquidations. A day later, as Trump addressed the nation and de-escalated the situation, Bitcoin once again moved with gold and oil, this time to the downside. So, what does this all mean? Is Bitcoin now a safe haven asset? Well, maybe in the right circumstances. Really though, this is an example of narratives willing themselves into existence. The initial coincidental price movement generated significant conversation about Bitcoin as a safe haven asset, and convinced some traders that others believed that Bitcoin was one. Knowing that, it made sense for some of them to make a similar trade on the next event, which only made Bitcoin look like more of a safe haven. Eventually, after enough of these cycles, Bitcoin may stop being traded like a safe haven asset because some people think it might be one, and will instead simply be a safe haven. These discussions came roaring back in late February, though this time it was skeptics of the safe haven narrative that were leading the charge. Bitcoin had sold off with just about every other market as coronavirus panic set in, leading some to say Bitcoin had failed to be the safe haven asset that many had claimed it to be. However, as Messari's Ryan Watkins explained in a great piece at the time, these critics had simply misunderstood what Bitcoin was a safe haven from. He wrote, "Bitcoin's case as a safe haven asset is not invalidated. Bitcoin is not a hedge against a recession. Bitcoin should not be expected to reliably hold value in times of severe market stress, and its performance last week should not come as a surprise. Gold did exactly this during the 2008 financial crisis. Instead, Bitcoin is a hedge against fiat currency. What Bitcoin provides protection against is not a slowdown in the economy, but the mismanagement of fiat monetary systems. What is a better dynamic to track is not how Bitcoin performs as markets sink due to coronavirus fears, but how Bitcoin performs in response to central bank stimulus to mitigate the economic impact of the virus." And we'll take a look at how Bitcoin performed there in the next section. Of course, to provide any form of protection against inflation and currency mismanagement, Bitcoin had to survive the turbulence and difficulties of March. And for a brief moment during the colossal sell-off on March 12th, some might have doubted that it would. On the day that became known as Black Thursday, Bitcoin experienced its second largest drop in history, falling more than 50%. The worst of the drop was due to the derivatives exchange BitMEX, who liquidated something like $1.5 billion worth of leveraged long positions between the 12th and 13th of March. BitMEX does this using an automated system called a liquidation engine, which groups many liquidations together and tries to sell them slowly and at a price that's favourable to traders so they don't lose more than they absolutely have to. On Black Thursday, that simply wasn't possible. An already substantial sell-off in the morning had convinced many miners, market makers and traders to wait things out on the sidelines, forcing the liquidation engine to sell into an illiquid market and pushing the price ever lower. BitMEX was stuck in an endless and destructive loop that would have driven Bitcoin's price to zero, until they were conveniently hit with what they claimed to be a DDoS attack, taking the exchange offline and ending the cycle. With most of the sell pressure removed, Bitcoin rapidly bounced back to above $5,000. Black Thursday marked Bitcoin's lowest point in 2020, but set it up to have a stellar rest of year by pressing short-term traders and those that were unable to hold through substantial drawdowns to sell to those building stable, long-term positions. It also forced so many miners offline that Bitcoin later experienced its second largest decrease in mining difficulty ever, with the only more significant drop occurring in 2011, well before the introduction of ASICs and the industrialization of mining. While this huge decrease in difficulty would have made life easier for the miners that survived Black Thursday, it didn't remove the pressure from them completely. They'd have just 2 months to ensure everything was in order before their income would be hit once again with the halving. Against a backdrop of unprecedented money printing and helicopter money, Bitcoin completed its algorithmically scheduled quantitative hardening on the 11th of May. To highlight this brilliant juxtaposition and to pay homage to Bitcoin's Genesis block, F2Pool included a headline as 629,999th block, the last before the halving. It said, New York Times, 9th of April 2020, with $2.3 trillion injection, Fed's plan far exceeds 2008 rescue. The 630,000th block was found by Ampool at 723 UTC. It cut the number of Bitcoin issued in each block to 6.25 Bitcoin, and reduced Bitcoin's annual inflation to something comparable to gold's. Those details don't really matter though. What was important was that Bitcoin was continuing along its predetermined path, regardless of the chaos in the world around it. Unlike every other money, there's no entity that can, through fear or greed, increase the number of Bitcoin that will ever exist, or change when they're created. It operates exactly as expected at all times, and that's what makes it such a great hedge against traditional currencies that can be severely damaged by their human operators. As central banks all over the world cranked their money printers to the highest setting, concern about the damage being done and an oncoming wave of inflation grew beyond the gold bugs and Bitcoiners that typically discuss those things. The money printer goes brrr meme shows that normal people were thinking about these things, and so too are major investors and CEOs who naturally wanted to position themselves and their businesses to minimize disruption and potentially even benefit from the chaos that might come. That's why the much talked about herd finally turned their attention to Bitcoin in the latter half of 2020. Just days before the halving, billionaire hedge fund pioneer Tudor Jones revealed he had allocated a low single-digit percentage of his fund's portfolio into Bitcoin. He also gave a thorough explanation of why he had chosen to do that in an investor letter titled The Great Monetary Inflation. As that title suggests, PTJ was pushed to investigate store of value assets because of concerns about inflation caused by an unprecedented expansion of every form of money unlike anything the developed world has ever seen. Jones tried to score different store of value assets according to their purchasing power, trustworthiness, liquidity, and portability. While Bitcoin was placed fourth on the list with the lowest score, Jones was still surprised with how well it performed. He said, Bitcoin had an overall score nearly 60% that of financial assets, but has a market cap that is 1/1200th of that. It scores 66% of gold as a store of value, but has a market cap that is 1/60th of gold's outstanding value. Something appears wrong here, and my guess is it's the price of Bitcoin. He also believes that Bitcoin will benefit from the coming digitization of currencies, with projects like Libra and China's DCEP set to make Bitcoin more understandable to a wider audience. Months later, in October, Jones reaffirmed his belief in Bitcoin, saying he'd grown to like it even more by that point, and that he thought Bitcoin was in its first inning with a long way to go. In the months in between, Bitcoin picked up a number of other big-name backers, with by far the loudest being Michael Saylor and his company MicroStrategy. MicroStrategy first announced plans to buy Bitcoin as a way to avoid inflation in late July. A few weeks later, they officially became the first publicly traded company to buy Bitcoin as part of a capital allocation strategy by scooping up 21,454 Bitcoin, worth more than $250 million at the time. In a statement at the time, MicroStrategy said that investing in Bitcoin will provide not only a reasonable hedge against inflation, but also the prospect of earning a higher return than other investments. Saylor then went on a tour of seemingly every Bitcoin podcast to explain how he had come to invest such a significant sum of money in Bitcoin. After realizing his company's substantial stockpile of cash was earning virtually no interest and could potentially be devalued by incessant money printing, Saylor started learning about Bitcoin. After digesting every bit of the information he could from Bitcoin luminaries like Andreas Antonopoulos and convincing himself that buying in was the right move, he set about convincing MicroStrategy's executives and directors of the same idea. He says he set a series of learning exercises to bring everybody up to speed. In the space of just 3 months, Saylor and his team went from having almost no knowledge about Bitcoin to buying $250 million worth. In September, MicroStrategy wrote in an SEC filing that Bitcoin served as the company's primary treasury reserve asset and hinted that they could buy even more. 1 day later, they did just that, adding another 16,796 Bitcoin to their stash to bring the total holdings to 38,250 Bitcoin. And they weren't done there. In early December, they announced not only another $50 million purchase, but a plan to issue convertible debt so they could buy even more Bitcoin. Some were skeptical about this, with analysts at Citigroup downgrading MicroStrategy to a sell, but there was clearly a lot of excitement too. What was initially announced as a $400 million offering quickly became a $550 million offering, which turned into $650 million when all was said and done. With all that money, MicroStrategy purchased another 29,646 Bitcoin, taking its total holdings to 70,470, purchased at an average price of just under $16,000. Over the year, the company had spent $1.1 billion on Bitcoin, almost equivalent to the company's entire market cap in August, before it had made any purchases. In October, Jack Dorsey's Square joined MicroStrategy in adding Bitcoin as a treasury asset, though their investment was comparatively tepid at $50 million. That equated to 4,709 Bitcoin, and represented about 1% of the company's assets in Q2. Square published a white paper alongside the news explaining their investment thesis, how they approached the buying process, and how they were keeping their Bitcoin safe. They wrote, "We hope the outline of our decision to allocate a portion of Square's assets into Bitcoin provides useful information to others contemplating a similar strategy." Jack Dorsey tweeted that sharing this information was more important than the investment itself, though it should be noted that a company as significant and respected as Square adding any amount of Bitcoin to their treasury is a major validation for the asset, even more so than MicroStrategy's far larger play. That same month, the $10 billion asset management firm Stoneridge Holdings Group announced that they had purchased 10,000 Bitcoin worth more than $100 million at the time to serve as its primary treasury reserve asset. Again, they cited unchecked and unbacked global paper money printing and increasingly negative yields as the driver behind this decision. From there on in, things only got bigger for Bitcoin. Towards the end of October, PayPal announced that their 346 million customers would be able to buy and hold crypto assets, potentially making Bitcoin more accessible and trustable to a larger audience of retail investors than ever before. In November, billionaire investor Stanley Druckenmiller admitted to owning a tiny bit of Bitcoin, predicting it would outperform gold and that it had a lot of attraction as a store of value to both millennials and the new West Coast money. Shortly before making those comments, Bloomberg had reported Druckenmiller was expecting to see slightly higher inflation in the years to come, and that he was shorting the US dollar. In December, the multi-billion-dollar investment firm Ruffer said that they had gained exposure to around $550 million worth of Bitcoin, equivalent to 2.7% of the firm's total assets under management. They described the investment as a primarily protective move that diversifies Ruffer's portfolio's investments in gold and inflation-linked bonds, and it acts as a hedge to some of the risks that we see in a fragile monetary system and distorted financial markets. Perhaps more significantly, that same month, the insurance firm MassMutual purchased $100 million worth of Bitcoin for its general insurance account. While this only represents a tiny fraction of the company's total assets, something like 0.04%, it's still a big story. It shows that Bitcoin is being considered and is appealing to another demographic of institutional investors, one that is typically highly conservative about the investments it makes. As these companies were buying Bitcoin, major commentators and analysts were showing their support too. JP Morgan analysts said that institutional investors appeared to prefer Bitcoin to gold, and that even a modest crowding out of gold as an alternative currency over the long term would imply doubling or tripling of Bitcoin's price. The research arm of AllianceBernstein, a global asset management firm who ruled Bitcoin out as an investment asset in 2018, tentatively admitted that Bitcoin does have a place in some portfolios, while Guggenheim Partners' chief investment officer told Bloomberg TV that he believed Bitcoin could go to $400,000. And a Bank of America survey revealed that long Bitcoin short the dollar was a highly popular trade in December. All of the excitement naturally impacted Bitcoin's price. In mid-November, Bitcoin's market cap broke its 2017 high of just over $329 billion, with Bitcoin's price hovering around $18,000. In December, Bitcoin finally plowed through its previous high point of $20,000, on its way to end the year at $27,000. Of course, it's already gone much higher than that in 2021, and I'm sure we'll see much more dramatic price action in the months ahead. As Ruffer Investments said in a portfolio update last year, the current macroeconomic environment is set up perfectly for an asset that blends the benefits of technology and gold. Negative interest rates, extreme monetary policy, ballooning public debt, dissatisfaction with governments all provide powerful tailwinds for Bitcoin. What's important from all of this is that the ideas of Bitcoin as a credible monetary asset and a hedge against inflation have received firm support and are well on their way to being properly validated. 2020 will likely be looked back upon as the year that Bitcoin started to go mainstream. But although it's undeniably exciting to see Bitcoin taking these great strides on the world stage and entering a new era that few early supporters would realistically have expected, there are some downsides to it. While the support of major companies and powerful individuals provides a degree of protection from significant government overreach, like attempts to ban Bitcoin, those parties are unlikely to defend essential Bitcoin properties like censorship resistance and pseudonymity. For example, how many of Bitcoin's new supporters wrote to FinCEN to argue against their proposed wallet rule that would significantly harm privacy? In fact, major banks and investment firms may even advocate for greater restrictions and burdensome requirements as an attempt to kill off smaller Bitcoin companies that could compete against them. And though wealthy white men and multi-billion-dollar companies are certainly welcome to own Bitcoin, they're hardly the audience that will receive the biggest benefit from or understand the full importance of Bitcoin. So as we enter a world where Bitcoin is increasingly significant and widely held, we may have to fight even harder to ensure its cypherpunk origins endure. So that's it for this video recapping 2020. If you want to see some others in this series, I'll put links to it in the description below. Thank you so much for watching, have a great day, and I will see you in the next video.